Good morning, everybody. My name's Paul Myliotis. I'm Managing Director of Msquared Capital. I have with me today my joint founder and good friend of mine, Paul Miron. Before we start, I'd like to draw your attention to a disclaimer that today is just general information and shouldn't be construed as advice. Now, who would have thought that we'd be saying the disclaimer via video link as opposed to be speaking to you in person? What a year it's been this year.
It's been an absolute crazy year. Look, my grandmother is currently 101 years old. She's an absolute sound of mind. And she's basically saying that it's a bizarre year. It's nothing like she's experienced. And she's seen a lot in her life as well. Everything is turned upside down.
We've had COVID.
Yeah.
We've had the US election.
The geopolitical space has actually changed. We've had floods, we had droughts, we had bushfires. You name it, we've seen it this year. So there's a lot of changes that's actually happened. But most importantly, it's actually why are people listening to us today? It's because of the low interest rates. And that is the biggest change that we're going to see.
Now, we've never seen interest rates this low in our lifetimes. So why is it so important for self-managed super fund investors?
Yep.
And what do they need to know with the low interest rates?
Well, look, in combination with the low interest rates and the fact that Australia has now joined the international club of QE, which is quantitative easing, is that we're going to have low interest rates for a very long time. So, for example, the 10-year bond rate, it's lower than 0.7%. What that means is that we have an expectation that low interest rates will be here for a very long time. By having such low interest rates, it's actually changing the characteristics and the way that asset allocation will happen going forward. So you can't really rely on a 60-40 split like we had before, 60% shares, 40% bonds. The characteristics of each particular asset class is going to change significantly.
Yeah, look, people can't hold all their money in cash. I don't know, we were speaking about it the other day. With $160 odd billion worth of super fund money held in cash, such a huge number. With interest rates now not being your risk-free rate anymore because people are losing money.
They're going to be losing against inflation. So that in itself is actually changing the characteristics, and the flow of capital is making a huge difference as well. So the characteristics or the profile of, for example, property shares and things such as that, the risk is actually increasing. So, you can take an example with property at the moment. Property prices or certain investment properties haven't actually decreased, but then you've got vacancy rates at 10%, you've got rentals is 30% lower than it was before, and it doesn't actually make sense.
Gotcha. So things are changing in the way that was traditionally the way you invested. We believe that there's going to be a flow of allocation from cash to alternative investments. Yeah. We are one of those alternative investments at Msquared Capital, and I want to just go briefly in terms of what we actually do. So Msquared Capital, we are a private credit provider. We're otherwise known as a non-bank lender. We match borrowers that need money with investors that have money that want a monthly return. We secure the investments via registered first mortgage over real estate in the eastern seaboard of Australia, predominantly in Sydney.
And I think it's important to say there as well, is that we run what's called a contributory fund, meaning that people can choose a specific mortgage they would like to invest in.
Look, I think that's very important. I'm going to bring my father-in-law into this. He loves when I bring him in. Alan is a self-funded retiree. He was an engineer for a good part of 50 years. He's very active in his investments and very active in managing his self-managed super fund. He's an investor into our fund, and he does not like to be pulled into investments that he doesn't understand or like. So he doesn't want to be pulled, for argument's sake, into doing construction loans. So this type of structure for Alan is brilliant because he can directly invest into the things that he likes, and that is the difference with Msquared Capital. Now, who would have thought over 10 years ago, well over 10 years ago now, we lent our own money in our first transaction because we saw such a gap in the market.
Absolutely, and the gap in the market still exists today. And I can tell you this, is that there's no bigger honor of actually co-investing with your family and friends and responsibility there as well. So, look, that's pretty much our ethos in relation to our business, is also to be giving our investors the tools and the platform to be able to make the right decisions in relation to which mortgage actually is right for them as well.
Look, I think that's very important. Now, we've scaled the Msquared business to be able to take other people's money and invest it on their behalf. It's a great honour to be able to do that. Now, we know property, we love property. Our investors know that we love property, but we also care that it's not a one-size-fits-all model. I think that you're not doing yourself a service if you think that one investment class is the same.
And it's really important to note here is that everyone thinks that a mortgage is a very homogeneous product. It's absolutely not. Every single mortgage is so different. They vary in characteristics. They vary characteristics in relation to obviously the return, the length, who the sponsors are, the securities. So really that type of dedication and detail needs to be done in relation an assessment by the investor to be able to make sure he's choosing the right opportunity for himself.
So Msquared offers investors the ability to diversify their portfolio by investing in standalone direct first mortgages. Now, Paul, we speak in a lot of jargon. Let's break down how it actually works.
Look, in a very simplistic way, we have a borrower who wants to buy, for example, a commercial building. It could be many different reasons, but a commercial building in this example. Msquared reviews the loan proposal, security, property, the borrower and their financials. Once satisfied, Msquared moves forward with arranging a loan via first mortgage. Msquared then gives the opportunity to investors so they can share in the benefit of the income from the interest payments.
The last point I just want to put a bit more emphasis on. The way that our investors get their return is the borrower pays interest and they share in the benefit of that interest. It's as simple as that. It's Absolutely. As simple as that. So look, I think it's important for everybody to know who the executive team are. We are the ones that are managing the money, and I think that's a very important part. So, Paul, you started your business in banking. I started my career at PwC in tax, but we share very common paths.
And we had a very similar path. We created two very successful financial services business that actually has morphed into Msquared over time as well.
That's right. So that's the history of us two. But there's one important player in our business that would love to be here, but he couldn't fit on screen. A gentleman by the name of John Thomas. Now, John Thomas is our chairman and he's head of our credit committee. Now, John is often referred to as the grandfather of mortgages. He's been in the industry for over 44 years. He actually ran the biggest fund of its time, Howard Mortgages, which was over $3 billion, which eventually morphed into Challenger Bank, and it was a very successful business.
And you know, JT's, or he likes to call himself JT, John Thomas, he's very passionate about credit. And it's very important to have the discipline to always to follow these particular processes and systems as well, and which we will share with you today.
Look, there's a reason why he's never lost a dollar in his illustrious career, and that's because there's no negotiation with the way that process has to be followed. Now, one important aspect as well, as part of our credit committee, we need unanimous decision.
So all three of us have to sign off.
All three of us need to sign off. So if JT, for argument's sake, does not like a process or an investment opportunity, the deal doesn't get shown to our investors. So Paul, the best way I feel to showcase what we do is let's go through a recently settled investment scenario that we did, so everybody out there can actually see the way we do our credit and what's in it for you. So this particular transaction, we had a borrower that came to Msquared with a need for finance. She had a very complex borrowing structure that the major banks couldn't get their head around. That's a perfect borrower for us. It's a perfect borrower because we have the expertise to look through the complex structure. So again, great borrower for us. So the first aspect that we looked at was collateral. In the unlikely event that the borrower could not meet their interest payments and we had to recover our investors' money, well, what's the underlying security? It's a very important aspect of credit. In this instance, it was a block of units in Balmain. There were 14 units. It was fully leased. It was fully leased. So it was in the heartland of Sydney, Harbour Bridge views, fully leased. It was a tick for us on collateral.
The other thing is character. In relation to character, we look at the past performance of the particular borrower. We do credit searches on them as well, because that gives us an indication in relation to how they will behave in relation to future debt obligations as well.
Look, they say lepers don't change their spots, right? So while it's not always the case, history does tell a good picture. Character is very important. In this particular instance, it was a borrower that was known to Msquared. She'd returned money before. We were happy with her character. The third and fourth aspects is capacity and cash flow. We pay our investors monthly distributions, so the borrowers must have the capacity to make the interest payments monthly. So cash flow and capacity is very important. In this particular instance, the borrower had $11 million in net assets. She had the property was fully leased and she had cash reserves to meet the obligations. So in that instance, again, cash flow capacity was a big tip for Msquared.
Competency. Look, you want to see that they have a track record. You want to see that they're competent in relation to what they do, and in their particular field as well. I think is very critical.
Yeah. So in this particular instance, she was a seasoned investor. She had plenty of property. She had plenty of assets. She knew what she was doing. So competency was an easy tick.
Yeah.
So all in all, what we've covered here is all aspects of credit. It's not good enough just to look at collateral or character. You need to look at all the 5 C's.
And this is the biggest point that we would like to make. When you're assessing an opportunity into a mortgage, you don't want to do it in isolation. It is a combination of all 5 elements which actually dictates the type of risks that are associated with that particular transaction.
Absolutely. So what was the benefit for our investors? Well, our investors got a net return of 7.4%. A very strong return for the asset that we saw. So our goal is to provide a comfortable retirement for our investors so that everyone can sleep at night. We don't want to be worried that interest payments are not going to be met.
And look, and in this particular opportunity, we had 50 investors. But what was in common with all those 50 investors, and the majority of them were self-managed super funds as well, is that what was in common is that they required a regular income that was secured against a quality asset so they can actually sleep at night as well. So that's really, really important.
So on that aspect of alternative investments, you wrote an article that got a great review from our investors. And it was asking the real hard questions that you should be asking when you're looking at alternative investments.
And when I was actually writing this, the idea came from is that while I was writing an article, I actually saw an ad in the paper about great opportunity, 11% return, and brochure looked fantastic, and I thought I'd actually start looking into it. Now, personally, as a person who actually manages other people's money, these are the first things that come into my mind. So the first one is, do I really understand how the investment works? So is it a bond? Is it a debt facility? Is it a equity situation?
Yeah, look, we've seen too many things being masked as low risk when they're super high risk. So Warren Buffett has the same philosophy that we have. If you don't understand the investment, run a mile. Don't touch it. Understand what you're doing. So that was the first aspect.
The other one is, do I understand the business case? So we've just gone through and explaining how interests are actually being given to how we share the interest with our investors from the debt obligations. Now, you have to ask yourself, do I understand how the investment works? Does actually underlying business that actually supports the investment has any income? What is it?
So the one thing we say, Paul, is does it fit the pub test?
Yeah.
Will you get laughed out of the room if you explain what you're investing at to your friends at the pub? If the answer is yes, again, I'd suggest to you it's not probably the investment that you should be looking at.
Another one is the security. We're both very, very passionate about. We don't do specialised security, and there's a very good reason why we don't do specialised security.
Well, just back up a second regarding security there, Paul. Now, security is a very important thing, and what we're saying is not all security is the same. Msquared, we don't like specialised, you've mentioned it. We don't like pubs, we don't like clubs, we don't like bowling alleys. We don't like land in regional areas, even though we like regional Australia. And the reason is, in the case if you needed to sell those assets quickly to recover money, specialised assets generally drop in value if you needed to fire sell, and they take longer. So we choose as our business not to take those as security.
Yeah, that's not in the best interest of our client. But also is that if any investment that you're looking at, if number one and number two passes, okay, and the business doesn't work, what security do you have? And I think we've got plenty of examples of, for example, you got Virgin. There was $750 million invested into Virgin in November of last year by unsecured bondholders.
Look, and again, that's knowing the underlying security. We're a secured lender. You can walk and drive past the property, and when you're looking at bonds of a company, what's this underlying security? So again, the security is very important and should be at the top of your list. Your fourth aspect, Paul, which we are very passionate about, is are you able to get the due diligence that you need to make your investment decision? Some of our investors like a 2-page summary. Others like all of our due diligence, which we're happy to give them, which is the valuations. It's got all the credit searches. It's got all the history. It's 100 pages. And others just want to pick up the phone and speak to one of us to talk through the investment. Now, we believe if you cannot get more than an executive summary from your fund manager, then there's something wrong. What are they hiding? Why won't they provide you with all the information? So be very careful when people are holding information from you, considering it's your money you're investing.
Yeah, and we've got a lot of self-managed super fund trustees who are very educated and have significant backgrounds. And they love the fact that they can pick up the phone to us personally and say, look, I really want to go through this transaction. I've read your due diligence. I want to ask a few more questions, and I want to understand your logic. Every single deal has a story, and there's a lot of essence.
And to be honest, we get our rocks off by speaking to investors, as boring as that sounds. We love it. And the fifth aspect, which is the last one, is can your investment withstand an economic shock? Now, we're living in an economic shock, and we've seen in the last 6 months certain investments
performing really well,
and some really badly. With Msquared, we're a secured lender that generally doesn't lend more than 65% of the value of the asset. So for our investors to lose money, the property prices would have to drop 30% or more. And when our securities are based in Sydney, that is unlikely to happen. In saying that, you are up the yield curve, you're not in a term deposit, so you must be careful with the investments that you are doing. Now, if you'd like to join the Msquared family, we'd love to have you on board. Please go to the website vip.msqcapital.com.au/Switzer. It will come up on your screen. We'd love to hear from you. Thank you very much.